Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to talk about the risk and return of portfolio. An investment portfolio is any collection or combination of financial assets. When you bought 3 company shares, these company shares are your portfolio. If we assume all investors are rational and therefore risk-averse, then investors will always choose to invest in portfolios rather than in single assets. Investors will hold portfolios because it will diversify away a portion of the risk that is inherent in putting all your eggs in one basket. Remember, don't put all your eggs in one basket. If an investor holds a single asset, he or she will fully suffer the consequences of poor performance. The goal is to form a well-diversified portfolio of assets, so that the risk will become lower. To calculate the portfolio return, we take the weighted average of the returns on the individual assets from which it is formed. Based on this formula, portfolio return can be calculated by taking the summation of the weight of each asset times the return of the asset. To calculate the portfolio standard deviation, this is the formula we apply. Let's take an example. Suppose you have $15,000 to invest, and you have purchased securities in the following amounts. What are your portfolio weights in each security? To get the weight of security A, you just need to take $2,000 over $15,000, then you will get 0.133. Do the same for B, C, and D, then you will get 0.2, 0.267, and 0.4. Consider the portfolio weights computed previously. If the individual stocks have the following expected returns, what is the expected return for the portfolio? By taking the weights multiply with the returns, you will get the portfolio return, 15.41%. Let's try the next question. Consider the following information, where you invest 50% in asset A, another 50% in asset B, and the returns for each state of economy are estimated. Boom means good time, whilst bust means bad time. Calculate the return and standard deviation for each asset, then for the portfolio. First, get the expected return and standard deviation for each asset. For asset A, by taking 0.4 times 30% plus 0.6 times negative 10%, you will get 6%. Then, take 30% minus 6%, square it, times 0.4, plus negative 10% minus 6%, square it, times 0.6, you will get the variance for asset A, 384. Then, open square root for the variance, you will get the standard deviation for asset A, 19.6%. For asset B, follow the same way. Then you'll get return 13% and standard deviation 14.7%. Next, get the expected return and standard deviation for the portfolio. First step is to calculate the portfolio return in Boom. Taking 0.5 times 30% plus 0.5 times negative 5%, you will get 12.5%. Then calculate the portfolio return in Bust. Taking 0.5 times negative 10% plus 0.5 times 25%, you will get 7.5%. Expected portfolio return can be calculated by taking 0.4 times 12.5% plus 0.6 times 7.5%, you will get 9.5%. Before you can calculate the standard deviation, you need to get the variance first. By taking 0.4 times 12.5% minus 9.5%, square it, plus 0.6 times 7.5% minus 9.5%, also square it, then you will get the variance of portfolio. Open square root of the variance, you will get the standard deviation of portfolio equals 2.45%. One thing that you may take note, portfolio return lies between return of asset A and asset B. But, the portfolio risk is very much lower than the risk of asset A and asset B. That's the reason of forming a portfolio. Do remember that, portfolio can diversify the risk, which means, it can reduce the risk. Another method of calculating the portfolio risk is by using this formula. First, you need to calculate the covariance. After this, the next step is to calculate the variance of portfolio. Then you can get the standard deviation, as shown here. Combining two investments can reduce the portfolio risk. However, it has to happen under certain conditions. Diversification is enhanced, depending upon the extent to which the returns on assets move together. This movement is typically measured by a statistic known as correlation, as shown in the figure below. If two investments are moving together, going up and down together, they are positively correlated. But if one going up while the other one going down, they are negatively correlated. Only when two investments are negatively correlated will reduce the overall risk. Generally, investing in more than one security can reduce risk. But if two stocks are perfectly positively correlated, diversification has no effect on risk, which means the risk cannot be reduced. However, if two stocks are perfectly negatively correlated, the portfolio is perfectly diversified, which means the risk can be reduced drastically. But in reality, it is quite impossible to find two investments that are perfectly negatively correlated. So, the rationale of forming portfolio is to choose assets with negative or low positive correlation to realize diversification benefits. Even if two assets are not perfectly negatively correlated, an investor can still realize diversification benefits from combining them in a portfolio, as shown in the figure. The risk after combining two assets becomes lower. So if you owned a share of 1,000 companies traded on the stock exchange, would your risk be diversified? The answer is surely yes. But would you have eliminated all your portfolio risk? Then the answer is no. Common stock portfolio still has risk. There are two types of risk in a portfolio. First is systematic risk or market risk. This is the risk that affects all firms, such as tax rate changes and war. Second is unsystematic risk or company-unique risk. This is the risk that affects only a specific firm, such as labor strikes and CEO change. Out of these two types of risk, only unsystematic risk can be reduced or eliminated through effective diversification. Market risk is also called systematic risk or non-diversifiable risk. This type of risk cannot be diversified away, for examples, unexpected changes in interest rates, inflation rates, tax rate, foreign competition, and the overall business cycle. That's why it is also known as relevant risk. We use beta to measure the market risk. Another type is company-unique risk, also called unsystematic risk or diversifiable risk. This type of risk can be reduced through diversification. For examples, company's labor force goes on strike, company's top management dies in a plane crash, huge oil tank bursts and floods a company's production area. So, if you invested in 10 companies, when one company didn't perform well, you would still have other 9 companies to make up the investment return for you. This is what we call diversification. Generally, if you combine more different company stocks into your portfolio, your diversifiable risk will be reduced. If you have 25 to 30 company stocks, your diversifiable risk will be reduced to the minimal. But for the portion of non-diversifiable risk, it is always the same and cannot be reduced, no matter how many company stocks you combine into your portfolio. Diversifiable risk plus non-diversifiable risk, you will get the total risk. Standard deviation basically is a measure of total risk. If you hold a portfolio of domestic assets only, your risk is still higher. But if you can form a portfolio of both domestic and international assets, your risk will become lower. Because assets or investments from different countries may not move together. When they don't move together, risk will be reduced. In summary, as we know, the market compensates investors for accepting risk, but only for market risk. Company-unique risk can and should be diversified away. Market risk cannot be eliminated through diversification, because that variability is caused by events that affect most stocks similarly. The standard deviation of returns is a measure of total risk. Beta is a measure of market risk or systematic risk. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.